Everybody's talking about AI. AI, AI. That is the global trend now. Good. It has made life easy and simple in this our present age. In as much as AI has its pros, it also has its cons. Because the intricate ethical considerations that arise with the increasing integration of AI in financial system or systems are the potential societal implications and challenges posed by these evolving technologies and are providing a thought-provoking perspective. Everybody is singing the praise of AI. Fine, AI is good. It's a powerful tool. But when it comes to the world of finance, it's something that needs to be taught and checkmated to the fullest. Now imagine a future where AI decides your financial fate. What if that decision, while efficient, was fundamentally unfair? So as AI increasingly runs our financial world, we are facing ethical dilemmas that could reshape society as we know it. The question still remains, are we ready to confront the true costs of algorithmic efficiency? Now picture this. A cutting-edge AI financial system flags you for a loan denial, but you can't get a human explanation. Or perhaps it's a trading algorithm that proportionately impacts vulnerable communities. So we are on the brink of an AI revolution in finance. But beneath the glossy promises lies a profound ethical traps. Let's uncover the silent societal shift happening right now. Hey guys, it's your boy Young Diamond. Welcome you once again to this channel. If this is your first time, don't forget to like, share, and subscribe to this channel. Click the notification bell. Each time we make a post, you'll be the first to be notified. Now let's dive right into it. Now let's unpack the hype. From trading algorithms to loan approvers, AI is everywhere in finance. But what are the hidden costs of efficiency? AI algorithms in finance analyze vast amounts of market data to predict the stock price movements, making split-second trading decisions that humans can't match. This system enhances, speed and efficiency in the financial market, but they also raise concerns about financial volatility and the potential for reinforcing bias. AI is also used to evaluate creditworthiness by analyzing data beyond traditional credit reports, like social media activities or transaction history. This helps create more personalized financial products, but risks excluding people with non-traditional data patterns or inadvertently reinforcing societal biases. When it comes to fraud detection, AI-powered systems monitor transactions in real time to identify and prevent fraudulent activities by recognizing patterns and anomalies in data. While this boosts security, it can also result in false positives, you know what I mean, or disproportionately target specific groups, raising privacy and fairness concerns. Now, the central question that we need to keep asking, are we creating a more efficient system or a more ethically complex one? Because while AI increases efficiency and scalability, it also introduces new challenges in terms of fairness, transparency, and accountability. Are we optimizing for outcomes that benefit society as a whole, or are we merely reinforcing existing inequalities and ethical dilemmas? It's just a fair question. Let's talk about the bias in the black box, the unfair outcomes. How historical data can embed biases in AI models, leading to discriminatory outcomes. Credit scores impacting minority communities, loan rejection based on geographical location and zip codes. So these are specific examples of the impacts or the bias in the black box. Because time is coming, our society will just be based on credit score. It is happening even in China today. Now, one of the most pressing concerns in AI systems, especially in the high domain like finance, is the black box problem. Especially AI models, particularly those based on deep learning or complex algorithms that can make decisions that are highly accurate but incomprehensible to humans. Because these systems, they analyze vast data sets and derive patterns, but often the rationale behind a specific decision, such as investment recommendations or credit scoring, which is not easily traceable. Now, in algorithm trading or in algorithmic trading, AI might identify patterns in market behavior and make trades based on that data. Now, while the trade might yield a positive financial return, the underlying reason for those decisions can be obscured, and this raises concerns. Lack of accountability is something that is still in the black box when it comes to AI. Now, if an AI system leads to a catastrophic financial loss or market disruption, understanding why that decision was made is often impossible without deep technical expertise. And also consumer trust. People are less likely to trust AI-driven decisions when they don't understand how those conclusions were reached. So when AI causes harm, who bears the responsibility? It's an ethical question. Who bears the responsibility? When an AI makes a harmful or erroneous decisions, such as approving a loan for someone who later defaults, or executing a risky trade that results in massive losses, who bears the responsibility? So responsibility becomes a complex issue. In traditional system, accountability lies with the individual or organization making decisions, like a loan officer or a trader. But when AI is involved, questions arise about who is ultimately at fault. Who is legally liable? If a financial institution uses AI to evaluate creditworthiness and the algorithmic denies a loan unjustly, does the bank bear responsibility, or does the developer of the algorithm bear the responsibility? What if AI made a decision based on biased data? Who bears the responsibility? That's the black box when it comes to AI. Or are the developers of AI systems liable for harm caused by their creations? And to what extent should they be held accountable for the unintended consequences of the algorithm? Now, for the financial institution, can a company that deploys an AI system wash their hands of accountability, claiming the AI made the decision on its own? Because with the evolving, AI potential, who bears the grunt? So this legal vacuum exists because the law hasn't fully caught up with the complexity of AI systems. Current legal framework, such as those governing negligence or contractual breaches, it doesn't neatly apply to AI-driven decision making. So thereby making it unclear who is responsible when things go wrong. Now there are so many challenges, for achieving true transparency when it comes to AI. Because many AI models, such as deep neural networks, are inherently complex and have millions of parameters that are difficult to simplify into understandable explanations without losing predictive power. Simplified explanations may sacrifice the accuracy and the precision that these systems offers. So a more interpretable model might not be as efficient or accurate as a black box model, which is complex. And this poses a dilemma. Do we prioritize human understanding and fairness over model performance, or vice versa? Because when it comes to standardization, there are few established standards for what constitutes a good explanation in AI. What might be considered understandable for one stakeholder, probably a regulator, may not work for another, maybe the consumer. So crafting universally comprehensible explanation is an ongoing challenge. Even if the AI model itself is explainable, the data it was trained on can be a black box in its own rights. Hidden biases in the data, which the model may have learned and internalized, which can be difficult to identify and explain because AI have an opaque data source. Now, the push for explainable AI is an essential step towards bridging the gap between cutting-edge technology and the human need for clarity and fairness in decision-making. But there's still a long road ahead. Developers, regulators, and stakeholders will need to collaborate closely to create AI system that strikes a balance between performance, transparency, and ethical accountability. Because AI cannot be given the free will without accountability. So with the gold rush of AI, we face a key question. Can we design AI systems that are both highly efficient and understandable? Is there an inherent trade-off between their complexities and transparency? And perhaps, more importantly, as AI continues to permeate high-stakes fields like finance, how do we navigate the ethical and legal challenges that arise when this system cause harm? AI could be a predatory practice targeting vulnerable population because as AI's ability to process vast amount of data with precision, it can be a double-edged sword. On one hand, it has the potential to improve services and increase efficiency. On the other hand, it can be weaponized for predatory practices, especially when those most vulnerable are targeted. You know that AI or AI system often analyze a range of personal data, including financial habits, social media activities, browsing histories, and even psychological profiles. While this can offer benefits, maybe more personalized financial services, it also opens doors to manipulation. Vulnerable groups, such as low-income individuals, the elderly, or people with poor credit are particularly at risk for exploitation. As AI can be used to tailor loan offers to people with low credit scores or predatory loan terms. Using behavioral data, lenders could push high interest loans to individuals who may not fully understand the implication of such debt. And the AI might target these individuals at the moment they are most likely to be desperate. For example, in financial distress, making it impossible for them not to accept the bad terms. And also, social media manipulation and exploitation also happens, where AI-driven ad algorithms can identify emotionally vulnerable individuals based on their online behaviors. These individuals might be targeted with exploitative financial products like payday loans or fraudulent investment schemes, at times when they are likely to make poor financial decisions, especially after a major life crisis, probably such as job loss, divorce, or financial crisis. And again, AI could be used by companies to adjust prices dynamically based on individuals' perceived financial vulnerability. Now, for example, an airline could increase ticket price for a person who consistently book at the last minute, or a utility company might charge higher rates, to those identified as financially desperate. And when it also comes to psychological profiling, For manipulation, AI could potentially build detailed psychological profiles based on people's online behavior and use these profiles to manipulate financial choices. For example, it could exploit a person's fear. It could exploit a person's fear or insecurities to sell them high-risk financial products or engage in emotionally manipulative marketing. It's just tactics. Mind you, AI systems don't operate in isolation. They are often part of an interconnected network, especially in sectors like finance, retail, healthcare, and even governance. So the risk of cascading failures becomes much higher when one AI system goes wrong. What really happens when one AI system goes wrong? Because AI systems in finance often rely on interconnected database and platforms. A single malfunction or error in one part of the system, such as an algorithmic trading strategy, can trigger a cascade of consequences in related systems, amplifying the damages or amplifying the damage. For instance, if an AI trading algorithm misinterprets a market data and executes a large volume of trades, it can trigger a chain or a chain reaction across multiple exchanges, leading to significant losses or a market crash. Now, in today's financial market, many systems rely on real-time data and automated decision making. A glitch or manipulation in one algorithm could rip through the entire system, affecting everything from stock prices to insurance premiums. Everything could be disrupted. AI systems used for credit scoring, for example, could misclassify individuals or groups and cause widespread financial exclusion, leading to a domino effect in markets and banking institutions. With all this lacks human oversight. As AI system continues to become more autonomous, human oversight diminishes, making it harder to step in and correct the mistakes when things go wrong. When one system fails and no one is monitoring or fully understanding it, the damage can quickly spiral out of control, especially if multiple interconnected systems rely on that decision-making process. Because AI learns from itself. When they're interconnected, they tend to bind and work and liaise with their systems. So the tendency for potential flash crash, market manipulation, or even a financial crisis triggered by autonomous AI is most likely inevitable, because AI's role in financial market is already substantial, with many trades made by algorithms and even entire financial products being managed autonomously. This brings both efficiency gains and significant risk. If not properly regulated, AI could create situations that destabilize entire financial ecosystem. And when AI-driven trading algorithms designed to make trades based on real-time data can inadvertently trigger flash crashes. A flash crash happens when a large volume of sell orders is executed by algorithmic system, causing a rapid, massive drop in stock price. These events are often amplified by feedback loops. When one algorithm triggers another, causing a domino effect, because AI can execute trades faster than humans can react. So the damage is often done before regulators or market participants can step in to intervene. Just like in the 2010 flash crash was triggered by an automated trading algorithm, leading to 9% drop in the US stock market in just minutes. While the market eventually rebounded, the event highlighted how quickly AI could create systemic volatility and market manipulation. because it has the potential to be used in market manipulation and in manipulating prices by creating artificial scarcity or abundance in specific assets or products. Now, for example, in practice known as spoofing, an AI can place large orders on the markets that it has no intention of fulfilling, creating the illusion of high demand or supply. This misleads the other traders in making decisions based on false information, artificially inflating or deflating prices. Over time, this erodes trust in financial systems and distorts the functioning of the market. Individuals are utilizing this process. Individuals are utilizing this process for fraud. And when AI learns of this system of algorithm, it can be more fatal. Now, a critical example, in 2020, the US Department of Justice charged a trader who used algorithmic trading strategies to manipulate the price of the US Treasury bonds. Though the trade was manually executed, it highlights the danger of AI systems being used to manipulate financial markets on a larger scale, because AI is systemic. Now let's talk about the potential financial crisis triggered by AI or an autonomous AI, because the complexity and autonomy of AI systems in finance, in extreme cases, could contribute to a global financial crisis. Imagine a situation where AI controlling lending, insurance, trading, and even global supply chain, and makes independent decisions based on a distorted data or faulty algorithms. And if a miscalculation in one system triggers a chain reaction across interconnected AI systems, it could collapse major parts of the economy. So it is something to look out for. Though good, but the disadvantage or the negative aspect cannot be neglected. Now, in 2008, during the 2008 financial crisis, the collapse of the mortgage-backed securities was exacerbated by algorithmic models that underestimated the risk involved. Now, if AI systems had been more involved in risk assessment and lending decisions, they might have compounded the miscalculations. That's a fun fact. So as the immense potential of AI continues to increase in efficiency and reduce costs in the financial sector and beyond, but unchecked AI-driven practices, especially in vulnerable populations, can lead to exploitation, systemic risk, and even catastrophic failures. So the interconnectedness of AI systems means that even a small malfunction in one could cause a ripple effect that destabilize the entire system. So the challenge moving forward will be ensuring proper regulation and accountability for AI systems, especially in financial markets, and putting safeguards in place to protect vulnerable individuals and major groups from exploitations. We need to develop AI systems that are not only efficient, but also ethically sound and transparent enough to prevent the potential for market manipulation, flash crashes, and financial crises, though inevitable, but could be brought down to the barest minimum. The complexity of these changes demands collaboration between tech developers, policymakers, and financial regulators to ensure that AI serves the public for good, rather than exacerbating inequalities or destabilizing the markets. Now, navigating the future towards ethical AI finance, there are so many actionable solutions that could be done or that could be carried out. Talking about stronger regulations, government and international bodies must establish clear, enforceable rules to ensure AI systems, especially in finance, are transparent, fair, and accountable. This means regular audits, risk assessments, and strict penalties for misuse. Also, neutral watchdogs should be created to monitor AI-driven financial systems. ensuring that decisions do not harm consumers, investors, or the broader economy. So an independent oversight bodies needs to be created. And also ethical AI development guidelines for financial institutions, which they must adopt principles that prioritize fairness, privacy, and inclusivity. These guidelines should be binding and it shouldn't be optional. So interdisciplinary collaboration needs to be enforced because responsible AI in finance cannot be achieved by technologies alone. Ethicists can help define fairness and guard against bias. Technologists can ensure transparency and explainability in algorithms. Policymakers can translate these principles into actionable laws and framework. So when these groups work together, financial AI becomes safer, more trustworthy, and more human-centered. So as viewers and participants, you can play a role in shaping the future of AI in finance by staying informed about how AI is being used by your bank, insurer, or investment firm. Advocate for stronger transparency. Ask institutions to explain how AI affects your financial decisions. And also support policies and leaders pushing for ethical AI regulations. It is very important that we join the conversation by engaging with professional forums, NGOs, or community initiatives working on responsible tech. The future of finance should not be dictated by algorithms alone, but with strong regulation, independent oversight, and collective action, we can ensure AI serve the people, not just for profits. It's still your boy Young Diamond. Do free to like, share, subscribe to this channel.